All right, welcome back. Today is going to be a little different video. We're going to talk about how to build a portfolio that works for you and your goals. And at the end of the video, I'm going to go over my portfolio, everything that's in it, and give you a little bit of insight into why I hold those assets. So first off, everyone's portfolio is going to be different because everyone has these different factors. Everyone has different risk tolerance, different time horizon when they need the money, different financial goals, and different assets that they like and want to hold. So we'll start off here talking about risk tolerance. Risk tolerance is your ability to handle volatility. So with higher risk comes higher reward. With lower risk comes more stable pricing, but typically lower returns. So Bitcoin and bonds, let's go to the extremes, right? Bitcoin is a lot riskier than bonds, but Bitcoin can offer you a much higher return than a bond can give you. But a bond is safe and you know what you're going to get versus Bitcoin, you don't know. So that's risk tolerance. Everyone has a different amount of risk tolerance. And so depending on you and your goals, you'll pick different investments based on your risk tolerance. Time horizon. So when do you need the money? Typically, if you need the money in the near future, you want to hold things like bonds, money markets, cash. You don't want to be in long duration assets because you don't want to liquidate those at who knows what price to pay out whatever expenses you have. So, but also when it comes to stocks, if you're looking for things for 10, 20 years from now, you can take a little bit more risk and you probably want to look for things to grow versus the short term, you want to take less risk and you're not worried about growth because you're going to have to sell the money or you're going to have to sell those assets and need the money in the short term. So typically younger investors, they have a longer time horizon. So they're taking a little bit more risk and they're looking at what's going to be the best investment 5, 10, 20, 30 years from now versus I just retired, I got a little extra money, let me put it into something. If you just retired and you want to invest in stocks, you're probably going to look at what pays a dividend, what's for sure not going anywhere in the next 5, 10 years. You may not say, let's go bet on the hottest tech stock that may go bust. So that's an example of time horizon. So you need to know your time horizon when you're building a portfolio. Is this to be cashed out in 5 years or 50 years? Because that's going to dictate what type of assets you should hold into that portfolio. Financial goals. Are you trying to make a 10% return? Are you trying to make a 2% return? Is this for retirement? Is this to buy a car? Is this to pay for a wedding? What is your financial goals and what is this portfolio going to be used for and when? So everyone's got a different objective there. If your goal is to, buy a country, you're going to have to take more risk and have a longer time horizon most likely than if you're just trying to, save enough money to buy groceries next week. Those are two totally different goals. So you need to know what you're trying to do. Are you trying to hit a home run or are you trying to get a base hit? And then asset allocation. This is, how diversified do you want to be? Do you want to be in the S&P 500, a basket of 500 stocks? Do you want to be 60% stocks, 40% bonds? What does that look like for you? And the allocation part kind of comes when you know your goal, you know your time horizon, and you know how much risk you want to take. So typically with people's 401ks, it's very diversified and it's a mixture of bonds and cash. And it just depends on when you're going to retire, how much, bonds and stocks. You have more bonds when you're closer to retirement because you don't want to lose the money and you don't want to be risky. You have more stocks when you have more time for that money to build and grow. You want it to build, but even then, it's very diversified. So you have 500 different companies, or maybe even more. So diversification, you hear everyone say, you need to diversify, you need to diversify, you need to diversify. And that is true if you are risk adverse. I have a different view on this, and there's a lot of investors, when they are doing things themselves, they have a different view on this. I don't own 500 companies. You'll see this in a minute. I do own some of the NASDAQ, which is a basket of stocks, but I hold companies that I like. So for me, I don't want to buy a basket of 500 stocks when I only like 5 stocks out of the 500. I'd rather say I'd rather be more efficient with my capital and say instead of putting money into 500 stocks, I'm just going to put it into the 5 that I really like. So Buffett famously says, diversification protects you against ignorance. If you don't truly understand the companies you're investing in, diversification can help you spread out the risk and prevent you from being overly exposed to a bad investment. So, if I really like a story, I'm going to keep putting money behind it versus, I'm just going to go buy all the stories and see what works and get a little bit of upside in all of them. So, diversification, know where you stand there. Do you want to own a big basket, or do you really like one or two things and you want to go into those, or do you want to do a mixture of both? So, that's asset allocation. And when it comes to investment selection, this is where you look at ETFs, individual stocks, what sectors, all those things. I really like renewable energy. I really like oil. I really like semiconductors. I don't like technology. I really like tobacco stocks, those type of things. What is your investment selection? And then are you going to buy an ETF? Are you going to buy a mutual fund? Those types of things. So again, these are just the general principles that you need to understand that'll help you build the portfolio that fits you and your goals. There's no right or wrong. There's no A or B here. It's what works best for you. So I hope that helps. And with that being said, let's do the portfolio reveal. So this is a little visual chart here of all of my assets. I currently do not own any real estate, and this does not show any bonds, CDs, or cash. But you can see I own a lot of tech. I got a lot of Tesla. Tesla was the first stock that I purchased in the pandemic crash. And I'm hoping to hold this for 30 years. So full disclosure, I'm not a financial advisor. I'm a dude on the internet with a flower on his shirt. And I do help people manage their portfolios, mainly family. So in here, I have all the portfolios that I have autonomy over. And so I put all the assets together. So some of these are for me, some of these are for family. And for example, one of these accounts in here is one of my mom's retirement accounts. And in there, we own some Tesla, we own some Amazon, we own some Enphase, we own the Qs, the semis, Google, Apple, and Vici. We own a little bit of bonds in there, and then we have some cash. But her portfolio is meant to be cashed out in around 10 to 15 years. So we have enough time that we want to take a little bit of risk, but I also have in there a little bit of bonds, some cash for if the market were to have a correction and we can buy some more assets on a discount. And we also own Vici, which is a REIT that pays 5%. So for me, instead of going 60-40, she's about 80-20, and I would say 20% of that is in a REIT, which is to me similar to a bond, but you're taking a little bit more risk, but you're also getting a little bit more upside because the REIT has potential upside. So that's an example of her time horizon and how we're still taking quite a bit of risk, but we are taking measured risk. And I have another portfolio that my grandmother has made where she stopped giving all the grandkids Christmas presents and birthday presents, and she just puts money into this fund that will be given to the grandkids down the road. So this is a 20-year time frame, hopefully. And in that account are 2 stocks, Tesla and Amazon. We used to have Google. We went heavy into Amazon. So we're taking individual stock risk. We're not diversified, but I have found the 2 best stories that I've seen out there, and we've invested into those. We are flat on our Tesla position and we're up on our Amazon position, but it doesn't matter. I really don't care what the return is because we are just trying to accumulate as many shares of these companies. And if another story comes around that we like, we will add to that story as well. But our time horizon is a long time from now. We're willing to take the volatility, willing to take the risk. I'm monitoring the story to see if something changes, like Google. I saw that I like Amazon better than Google for the next 10, 20 years. I still like Google, but I think there's more upside in Amazon, and I'm willing to take the risk, so that's why we made the change. And then when it comes to me personally, I own all those things I just mentioned with the addition of crypto, which is super risky, super volatile. But again, I'm looking for a high risk, high return, long duration. It shows on here that I have more Ethereum than Bitcoin, but that's because I have some altcoins that are on the Ethereum chain, so it looks larger than it is. If I show you this in a year, it'll probably be rebalanced again where I'll have more Bitcoin than Ethereum. And those are assets that I'm going to hold for a long, long time unless I see the story change. So for example, when the FTX thing blew up, I sold all my Ethereum and I sold half my Bitcoin around that time because things were not looking good and there was a lot of uncertainty. And then all of last year and a half since then, I was just dollar cost averaging into both of those. And now I'm getting out on the risk spectrum, going into some altcoins. But those are just trades to accumulate more Ethereum and Bitcoin. 10 years from now, I won't be holding any of the altcoins. Even 2 years from now, I won't be holding any of them that I have now. They're just trading vehicles to accumulate more of the two big guys. Now, who knows? Maybe something happens with Ethereum. Maybe Satoshi comes back to life, and I don't have any of these down the road. But that's the risk I'm willing to take because I'm 29 years old. I plan on working a long, long time, so I have time to have mistakes and have losses and recover for them. So I hope this helps everybody out there build a portfolio for themselves, for their family that matches their goals. This stuff isn't rocket science, and you can pay someone 3, 4, 5% to do this for you, or you could take a little bit of time, do a little bit of research, and start doing it on your own. Again, if you want to be diversified, I love the Qs, the triple Qs. I love the SMH. I love the semi stocks. Instead of buying Nvidia at all-time highs, I just bought the basket, and that's been doing really, really good. I'm up 50% on the SMH since last October or something like that. So being diversified as a piece of your portfolio, I think is great, or even your whole portfolio if you don't want to do the deep dive into individual stocks. But for me, I like that kind of stuff. And as you can see, I really, really like Tesla. I have very little doubt that 20 years from now, I'm going to be upset that I have this much Tesla. I may have a little bit of doubt in the next year or 2 years. Tesla hasn't been a good performer. It's one of the worst performers in the S&P 500. But for me, my confidence has not been shaken in the company. I need to see a lot more negative things besides the headlines and the stock price. So anyways, I hope this helps you guys. That is my portfolio. Full disclosures. It's out there. You see what I got. I got skin in the game, and I hope you guys do too. But that's all I got for you. Have a great day. Peace out.